Shah joins us now. It's always a pleasure to understand what his analysis of the market is and where is he investing capital and which is the next multi-bagger idea he has really struck upon. So Nilesh, we normally start with the market view, then we get into sectoral analysis, and then when we get into stocks. How about today we start with the change? Let's start with your next big idea.
Okay, Nikunj, bang on. But I think, Nikunj, clearly, we're seeing data and we're seeing news about what's happening really with our GDP growth rate. And obviously, of course, this year is expected to essentially be a year of a decline or a degrowth. And so I think clearly the top priority is going to be essentially businesses which are essentially agnostic to what's really happening with the GDP numbers. And so clearly I think pharma remains our top bet, our top pick. And I clearly believe that as a sector, pharma is basically set to kind of, in a way, sustain a double-digit growth rate over a multi-year horizon. So clearly believe that pharma is really the big opportunity there. Second, of course, is that we're seeing very strong demand for homes and residences, and I think clearly all the businesses connected to real estate construction, be it some of the tiles manufacturers or the wire and cables manufacturers, I think that's a very interesting opportunity. So that I think would be the second big pocket. The third, I think, Nikunj, is that I'd probably want to strike a bit of a contrarian note, and I think that you're going to see a fair bit of pickup in investment in infrastructure. And I think, therefore, some of the companies connected to, say, the power sector, the rail sector, which are going to be supplying a lot of equipment and things like transformers and etc. Our sense is that over the next 2 to 3 years, you're going to see a very strong momentum there as well. So clearly, these are the three big pockets of opportunities that we see. Pharma for a double-digit growth, the businesses connected to real estate, I think will probably do well over the next year or two. And then, of course, clearly sectors or businesses connected to some of the core sectors like power, rail, etc. I think these are the three big pockets of opportunities that we see.
You like pharma, but pharma is more like a consensus trade. It's like saying I like private banks because suddenly everybody likes pharma. Why do you like pharma? And what do you like within pharma? And after an average 100 to 150% run up from the March lows and maybe more in some pharma stocks, haven't investors missed the bus? Hasn't the train left the station?
So what I probably think is likely to happen going forward is that we've seen actually a much stronger run up in the tier 2, tier 3 kind of stocks within the entire pharma pack. And especially, especially pharma companies, which are more a play onto the API part of it. They have seen a very strong run up. But what I think going forward could potentially happen is that some of the large caps in the pharma space are beginning to look very attractive. And for example, our top investment idea is essentially Cipla right now. And that's been our latest addition. We think that Cipla, yes, it has essentially run up from the March lows. But in a way, if you look at it over 5 years time frame, Cipla as a stock has not gone anywhere. It's probably flat or maybe has probably given you low single-digit returns in a best-case scenario. But if you just look at it thematically, we have the coronavirus which is there, and the biggest after effects or the most common after effects of the coronavirus is essentially are the impact or the damage it does on your lungs. And therefore, essentially, it's going to create a much more widespread respiratory ailment. As it is, respiratory ailments are essentially the second biggest cause of deaths after cardiac related problems. And if you really look at the respiratory segment, the inhalation segment, clearly the company which really rules the space and dominates it and by a wide margin is Cipla. So to that extent, I think that the long-term growth trajectory for Cipla is pretty strong, pretty much sustainable. There seems to be a fair bit of longevity towards growth prospects. And yes, it has run up from the March lows, but if you look at it over a 5-year period, it's really not gone anywhere. So clearly, I think maybe investors which probably have so far been looking at, say, the small and mid caps in pharma, it's probably now time to look at some of the bigger names. And I think as a rally in a sector gets mature, you're anyway better off being in the larger names versus the mid and the small names. So I think clearly that's one idea which I think we're very positive about.
Bharti is on a tear today, 465 up 31 rupees. Okay. Nilesh, it's a great way of looking at Cipla, that they are a market leader in the respiratory segment. And unfortunately, COVID is something which is going to be having a respiratory impact, and you got to go to somebody which gives you lung protection, respiratory protection. But the juice in any pharma company, Nilesh, is that when you are in the generic space or US generic space, unfortunately, Cipla they don't have a formidable presence in US. And could that be a restrictive factor because their margins are not the best in the industry? And if you look at the ethos of Cipla, Nilesh, I mean, that's the ethos of company, that we believe in care and we are not a company which is going to chase profits.
In fact, Nikunj, this is something, this kind of ethos and value systems is something which is going to actually work to its advantage, because I think world over, there is going to be an increasing clamor for affordable healthcare and ensuring that medicines are essentially available in terms of the best quality, and that too at affordable rates. And therefore, I clearly believe that maybe a lot of other companies will have to probably reorient their thought process, their value systems, and their ethos. Whereas I clearly believe that this is something which Cipla has been practicing for a very long time, number one. Number two is, I think the margins in over the last few years have essentially got, in a way, they haven't been industry-beating margins, and that's probably because also of a couple of acquisitions which they made a few years back, which in a way has dampened their overall kind of financials. But what it looks like is that it probably seems to be at the cusp of a positive change. And of course, some of these investments which it has made into a very attractive market like the United States, I think are probably on the cusp of beginning to pay off. Still early days, but I probably believe that over the next year or two, these are some of the things which will start showing up in Cipla's overall business and overall financials. So to that extent, I think that maybe here we probably would be better off not only to do a very plain vanilla rear view mirror driving, but probably to look ahead and see how relevant Cipla's investments over the years, its efforts, its energy, the time that the senior management has spent. I think these, coupled with, of course, some of the opportunities which something like COVID is throwing up, I think is going to be, in a way, an excellent mix for a company like Cipla, maybe over the next few years. So to that extent, I think that makes us positive. So I think it's going to be more about the delta that one could potentially see in a company like Cipla.
Okay. Nilesh, we've been talking a lot about some of those domestic factors, but I just want to, bring up some of the other kind of elements that are just hovering above us all. And one is, of course, the threat of the second wave. All the narrative that we've heard, of late and more recently, including from the regulators, has been that the recovery is underway. And yes, the case count in India is falling, but we have some major event risks that seem to be around the corner, whether it's the US elections, of course, a lot of focus on that, but also these fears of a second wave that continue to loom and that could disrupt the pace of the recovery. Are you at all faced by some of the uncertainty that still seems to be looming ahead?
Oh yeah, I mean, these are clearly, real risks or real speed breakers to the recovery, undoubtedly, be it the US elections or the second wave of the coronavirus. I probably think that the US elections, of course, pose more a threat in terms of liquidity flows. And so to that extent, of course, India has been receiving some decent flows in recent times. And so to that extent, any kind of a risk aversion or a risk on mode essentially will basically impact flows and therefore could impact stock price movements. And so to that extent, I'd probably think that it's more an impact on liquidity rather than fundamentals. A second wave of the coronavirus, my sense is that I think it's not so much the virus which in a way cripples the economic activity, but it's essentially the lockdowns which in a way cripple the economic activity. And I probably believe that, I think this time around, the regulators and the authorities would essentially be more focused on ensuring that there's really not a nationwide lockdown or there's not really a very broad-based lockdown, but you could have pockets of lockdown. which could probably be very patchy. So I'm not sure if that is going to impact the economy in any significant manner. I also believe that we're probably far more well prepared in terms of dealing with another wave of the virus. And I'm honestly not too sure about the second wave, because we still seem to be in the first wave, and we probably have an extended first wave. And I think as a nation, as a society, and as individuals are probably far more well prepared than where we were in periods like March and April. So I'm not so much worried about the second wave. I don't think that's something which is going to impact significantly the economic activity. I think broadly, the economy and the demand environment right now has very strong tailwinds in terms of lower interest rates, strong liquidity in India. And I think that itself is going to actually be very supportive of demand recovery. In addition to that, of course, there have been companies which have been announcing rollbacks of essentially salary cuts and all of that. There are talks of another round of stimulus coming in from the government. So all in all, I still believe that the tailwinds which the overall demand environment currently enjoys, I think are far stronger than potential headwinds that we could face because of a second wave of the virus, or essentially whatever the outcome is of the US elections.
Fair enough. So on the demand recovery then, and we've talked about some of the other pockets of the economy, but when it comes to demand, what are you making of all the recent data points? I mean, there seems to be a sense that things are just bouncing back this festive season, particularly in pockets like auto or retail. But do you feel this is sustainable even post-festive season? It might take a little bit more time, or may not be. It may not immediately follow through. Might still take a couple of quarters to really settle down.
I probably think that on the auto side, probably right now, the talk is essentially, I probably think, is going ahead of the actual demand. And I would probably refer to what the Bajaj Auto Management has to say. And clearly, if you really look at the numbers yet don't really show us very, very strong recovery. I mean, I think that if there was a very, very strong recovery, and if there was a strong pent-up demand, I'd probably think that the deficit which was there in Q1 would have been more than made up in Q2 numbers. But that doesn't seem to be the case, especially for motorcycles I'm referring to. So despite all the talk of pent-up demand, personal mobility, strong rural economy, yet I'm honestly a little disappointed with essentially the demand for two-wheelers. So one will have to really see if this essentially sustains itself. I mean, the industry is still in a grind. The industry is nowhere close to where the numbers were 2 years back. So even forget on a 1 year basis, but I think even on a 2 year basis, the present numbers are still way below what the numbers were, not just a year back, but what they were even 2 years back. So I am yet a little cautious on that two-wheeler pack. We've seen stock prices run up, and probably some of them have gone back to around the pre-COVID levels. But I think one needs to be really careful with the two-wheeler side. What I probably think is that maybe the demand for CVs could be a tad better as we see, of course, programs like Atmanirbhar Bharat picking up, as the government tries to boost domestic manufacturing. What it really looks like is that maybe that's one space which may actually positively surprise us in terms of the demand. So versus two-wheelers, I think probably right now, it looks like that I would be more sanguine about a recovery back in CVs versus essentially motorcycles.
Nilesh, it's almost like the sectoral churn in the market is happening at the cost of IT. Well, there's no taking away from the fact that, yes, the stocks ran up pretty hard ahead of the earnings, and thereby that explains some amount of the selling which has taken place. But this profit-taking or selling so-called in IT has extended a little bit too much. While there's no taking away from the fact that the long-term prospects of IT are very much intact, but would you be tempted to buy this decline just yet? Or would you say, wait it, they've run up too hard, maybe some more selling could be in store?
I think, Aisha, what seems to be the case with Indian IT essentially is that It's been more a story of margin recovery rather than a very strong demand environment. While the industry would like to paint it as more a very strong demand environment, but I think it's actually more the margin recovery and the strong margins that they have had because of essentially the tailwinds that they have had on the currency side. Keep in mind that the rupee had depreciated quite significantly in the March and the June quarters. Second, of course, is that there have been a huge saving in their operating costs. And third is that they have not done salary hikes, most of them, and they're probably going to do it with effect from 1st October or 1st January. And that's essentially a significant cost component. If you kind of look at the demand environment, if you look at most of the IT companies, they're still kind of growing in low single digits or maybe at best mid-single digits. So keep in mind that I probably believe that the larger IT companies are more a play on the currency. And especially in context of the valuations at which they are trading at, one needs to be a little careful and cautious of them. I think it's better to probably wait right now and see how essentially the environment plays out beyond 2020, the demand environment plays out for them beyond 2020, and how things like the currency and all shape up. So that one has to be a little careful about. Of course, some of them have announced very aggressive buybacks. So to that extent, that will create some kind of downside support for these stocks, especially the larger names. But I think beyond that, I probably think that at these kind of valuations, I think investors would probably be better off waiting out before committing to basically the large cap IT space.
That's interesting. How meaty is still the trade, Nilesh, when it comes to the rural recovery? We've already seen the moves come in on a Marico, Dabur to an Escorts, to an M&M already. Do you think there are newer names which could participate in the rural recovery theme?
I clearly believe that I think when incomes go up quite dramatically, and that's essentially seems to have been the case for the rural economy, thanks to the buoyancy in essentially farm output. What it looks like is that there is an increase in disposable incomes. And I think a lot of banks and financial companies are trying to kind of reach out to the rural segment. The largest bank, HDFC Bank itself, has announced that its focus going forward is going to be semi-urban and rural areas. So I think on one hand, there's an increase in disposable income, and two is, of course, better delivery of credit to pockets of rural and semi-urban India. And I think that essentially is going to drive demand for a lot of the discretionary stuff. So while we've seen it play out so far in some of the names you mentioned, and it's quite possible that, of course, segments like two-wheelers may participate in that, because finally that's discretionary demand. When you feel good, when you have better incomes, you want to essentially change your motorcycle more frequently than what you would. Instead of, say, 7 years, you'd probably do it in 3 or 4 years. That itself could drive demand. But I think in addition to that, rural housing essentially, I think, is a very, very important segment to focus on. So I think demand for cement, demand for tiles, demand for kitchen appliances, these are some of the things which essentially could probably witness some pretty strong demand as we move forward and as we move beyond the festive season. So this is one pocket on which we are very positive about, and I think that's something which probably will play out over the next several quarters and definitely beyond the festive season.
In this comeback, will you not buy cement, steel? Would you buy infra? Because that's where a classic value investor would say, "Sasta ho gaya hai."
I don't know if any of these things are truly Sasta, Nikunj, because I think clearly, and if there's something which is terribly Sasta, then maybe it probably is a value trap. But I think clearly what happens is that with some of the names that we discussed, as the demand kind of gets better, some of these companies and businesses will enjoy operating leverage, which will drive margins and therefore drive earnings. So to that extent, I think the intrinsic value of some of these companies could kind of, keep inching up or keep increasing over the next few quarters or the next few years. So that essentially, I think, should be the key investment thesis. I don't think that any of these stocks are necessarily cheap from a conventional perspective. It's not that they're trading at single-digit P multiples or anything like that. If at all, they're trading at multiples which are in double digits. But I think what is very interesting is not so much just the absolute P multiples, but I think the delta that one is basically seeing in terms of the demand, capacity utilization, operating leverage, margins, and earnings. And I think that's essentially the core of the investment thesis.
Okay, Nilesh, appreciate your time and season's greeting once again, and certainly hope to see much more of you going forward, and hopefully for some of our Diwali shows as well. Thank you very much, Nilesh.
Thank you.
Well, it's turning out to be a big day for Bharti.